welcome them. And First of all, again, thank you for everyone joining us. It's wonderful to have you with different time zones, and I know you could do some other things, but I really appreciate being part of our 90 minute, maybe a little more, a little less, as far as what is going on with the markets. Um, Last week was another exciting week, and I like to give you the outline what we're going to do. But before I do that, again, I want to thank Dr. Sean Lee for all his help. It's not easy to put these technology things together. I know sometimes I sweat it, but Sean, thank you so much for all your help. I
Oh, it's
appreciate
my great
that.
pleasure.
Thank you. All right, so uh, let me give you the outline what we're going to do, and it's uh, what I like to start. As you know, we've been hearing a lot about the slowdown economy, what is happening, are we going to have a recession, which is most likely is 100%. Uh, then what I'm going to do through our journey, we're going to, as you know, I'm a very big believer in history. I believe we learn a lot from history. And I like to go to a journey, go back to the financial crisis of 2008, 2009. In the past, we have gone through the 1929, 1930s to 1999, 2000 era. After that, we will review what is my outlook, why markets are doing what they're doing, and is there light at the end of the tunnel, or this is a false light, maybe due to uh, really so much influence of the financial, monetary input of the money. I will share, and I call it anatomy of a future trade. Just as I mentioned before, this is a wonderful trader's market because of the volatility. I know many of you do not do futures trading, but I thought I'd share just one, which I did on Thursday evening and Friday morning, just give you my reasoning about that. And I will end this with, I thought every week it will be nice to have the financial terms of the week, just learn something new from either analyzing stocks or funds, and just have something that we can use in our financial investment, hopefully, journey. And the last one, every week, as you know, I share a website which I feel it could be useful. They are all free websites. They do have some premium editions, but I think it gives you enough tools to become independent. Before I go to description again, I like to emphasize my mission and why we are having these hourly or 2-hour gathering every week. Is my mission is to make sure I give you enough tools that you feel confident enough to make your own decisions. I've mentioned it before. What happens is with the TV pundits, the politicians, even the governments, they give us what they want us to hear. And I'm hoping that maybe by sharing some of my ideas and some of the instruments that I use, you could have a little independent mind and filter a lot of noise that it comes through. So before we do that, if I analyze the markets and go to the history, I thought it's very important to have a good understanding of what is GDP and recessions. The National Bureau of Economic Research, which is short, it's called NBER, it officially declares recessions. That's their job, and they're the ones who declare, and they're usually late, but anyway, they do. They define a recession as a significant decline in economic activity spread across the economy. It usually lasts more than a few months, and normally it's visible in real GDP, real income, employment, industrial production, and wholesale retail sales. In the past, you've heard again the financial pundits, and a lot of people use that the two consecutive quarters of decline in real GDP. But NBR has come and said that's not really how they like to define it. Although in UK and other countries, they still follow the two consecutive quarters of decline, which is really the slowdown. Interesting about recessions, most of the time, economists don't agree till it's over and years later, they say, oh, we did have a recession. As a retail investor and an average ordinary person, usually we get the feel that something is not right ahead of, I think, the economist. So what is this GDP and how does it influence our thinking, our decision making with through the investing, with our careers, and in some of our purchase plannings, and the other major decisions. So the official meaning of GDP stands for gross domestic product, and it represents the total monetary value of all the final goods and services produced and sold in the market. Now, this is a very important distinction between the GDP, which we use now, and we used to use gross national product, which was a GNP till 90s, and then we changed it to GDP. All the production happens within a country during a period of the time. So it could be within a year, for instance. What happens is anything that happens, let's say we are in the United States, most of us, if it happens within our borders, that contributes to the numbers and to our production. The GNP was if you're a citizen of the United States and you had a business overseas, let's say in China or India, that's how it used to be calculated. So if you had a foreign company in the United States, that would not be included, but now it's the opposite. If the Mercedes or BMW they have, or Hondas or Toyotas, they're in Alabama, North Carolina, Tennessee, whatever they produce, that contributes to our GDP economy and numbers. Now, basically, GDP is the most commonly used measure of economic activity, and that's why you do hear a lot about what is happening, what is going to happen with the future. It affects how the monetary and fiscal reactions happen due to projection of, are we going to have the slowdown? Are we going to have expansion? So basically, GDP is the most important factor in as far as influencing our decisions. So what are the components? I hear some noise. Would you mind if you mute? I don't know who. So I appreciate it if it's muted. So now the GDP is basically it's the private consumption, which is really the consumers. It's plus gross private investments, plus the government investing, and then it's the investment and the spending all in one. And then we have the net exports, which is exports minus imports. And for some of you who love formulas, it is C plus I plus G plus X minus M. Now, one setback about definition of GDP, and sometimes it's not the true indication of the financial economic activity in the country, is due to underground economy. Now, a lot of emerging and developing countries, frontier countries, some of you are familiar with them. Some of them have been like one of my favorite economies in the past few years that I've been gradually investing is Vietnam. Now, first of all, the numbers usually are not accurate, and we go back to 90s, and I can give you some information. Like with China, there's always this joke that China really doesn't give us the real GDP numbers. They make that number, and then India always likes to beat China. So if China has 6, India says I have 6.5. It was a old joke in the 90s. So sometimes these numbers are made up. It has gotten much better, but due to the underground economy, and I use Vietnam again, and what I mean by that is like really a black market. There's a lot of cash transactions that they are not reported. And consequently, the tax revenues are not there in those countries. So it makes it pretty difficult to completely analyze an economy of, again, a developing country. As I mentioned, it's getting much better because of the flow of funds to these countries. So a lot of analysts and fund managers, and I think they have to do a lot of due diligence. So they do that, but still it continues to happen. So that's one thing I just want to make sure the GDP doesn't give you the complete picture. So let's analyze what does that mean when we talk about private consumption or the consumer spending. And why is it that's so important? In the United States, we are a consumer-driven economy. Now, what that does, the reason is because the consumer spending contributes about 70% of the total production. To give you the numbers, in 2019, that was $13.28 trillion. And what I mean by consumer spending is basically what consumers spends their money on. There are three major services. One are actual tangible investments, which are the durable goods and non-durable goods. And the second part is the services, which are not tangible. So in durable goods, when we talk about durable, means they have duration, so some longer lasting products, such as cars, furniture, large appliances. The non-durable goods are clothing, food, fuel, that you can see they don't have a large duration, a long duration. The major, actually, part of our GDP is through services. Now, that's banking, healthcare, education, and that represents 45% of GDP. Now, again, when we analyze emerging and developing countries, we used to have, again, labor and the capital spending, they used to be a big factor. As economies grow, they become more service-oriented. And that produces more middle class, and that's how you can see if this economy, when we look at the demographics, will this last a long, as far as prosperity, or a short? So you will see that a lot of developing countries start moving toward more service-oriented rather than just the good consumption orientation. So basically, that's why it's so important for the United States that when the Fed comes and injects all the money, and then the government, the fiscal policies try to get the people back by sending them checks or trying to help the businesses, because they want these activities to go back, and that's when the consumption, when it gets back. And that's where, again, independently, you can make your judgment whether we are there, and do we have the consumption is back, let's say, where it was, let's say, in October 2019. So that's one thing, and I'm gonna kind of bring everything together as far as how the stock market is reacting to all this news. The second part is the business investments, and that includes the purchases that companies make to produce consumer goods. And what I mean by that, this is real, it's not repurchasing, this is actually producing things. So in 2019, the business investments were like $3.4 trillion, which represents 18% of the US GDP. Now, the recession low of 2009, we were at $1.5 trillion, but in 2019, obviously moved up to 3.4. And construction, which includes the commercial and again residential, is part of this business investing. And again, this is new constructions. In 2019, we were at 1.11 trillion, which was about 5.8% of our GDP. In 2010, it went as low as 748 billion, or 5.1%. The third element is the government spending, and that's what you see now, and that's what they're trying to do by pumping the money and then trying to rejuvenate the businesses by investing trillions of dollars. So in the past year, we had $3.3 trillion in 2019, and that was 17% of the total GDP. And the federal government spent about $1.28 trillion in the programs, which about 60% was the military, and then states and local governments, they contributed about 11% to that 17%. Now, if I add these three, 70 plus 18 plus 17, that comes out to be 105. So the numbers don't add up, but they do, because the fourth element and part of the equation is the net exports of goods and services. Now, exports, that means we gain money. So when we're exporting, that adds to our GDP. Imports is when we actually import things, we have to pay for them, and that's when it's subtracted. Now, in 2019, we imported 3.49 trillion, and we exported 2.53 trillion. So basically, this is where that negative 5% comes, because we exported less than what we imported, which was $0.95 trillion. Now, basically, this is the reason I want to go through this. So now when you hear the news, you can make your own decisions. Are the consumption going up? With all that, have we gotten checks? Are the people going out and spending money? So what I did, this is a table from the NBER actually. Okay, so I'm not going to go through the whole thing. You can just want to have for your records to see where all the amounts that I coded in 2019 come from. As you can see, again, the 17%, 18%, and then you can look at the net exports and where all the spending and consumption comes from. All right. Okay. So basically now, we live in a wonderful country. Most of us in the United States. It's fascinating that we are very fortunate that we are here. But history, I think, gives us a lot of lessons. And unfortunately, such a young country we are so secluded from the rest of the world. We have not had any experiences as far as having the civilizations that we can go back and learn lessons. This country is so vast that we have never really been invaded. I mean, Pearl Harbor was really the first thing. We came to this country. They were the indigenous residents of this country. They were all over. You know, we kind of cleaned them up and took over the country. And we have a very short history. So history is not emphasized in this country, and it happens in investments. I mean, when 9/11 happened, that was like the first time we felt that something happened in this country. Now, coming from overseas, many civilizations have gone through many cycles, and people who grew up there, they have a different appreciation for the history. And they have, if you read the rise and fall of, let's say, a Roman Empire, we can learn so much from the. It's not just about the quantitative and physical things. It's about human mind. It's about our greed. It's about our drive to power. It's about our fears. And our brain, you know, in the last 260 million hasn't really developed that much. Frontal neocortex still there. We still have the same emotions of the fear and flight, and those elements still there. So our behavior goes through the cycles. Our minds go through the same cycles as even 5,000 years ago, 10,000 years ago. So I love, as you've seen in previous presentations, I think history does repeat itself because as humans, we repeat our behavior. So every session, you've noticed, I go back to the history, and I like to see what happened. Previous times, we did look at the 1929 and 1930s to debacle of, you know, the technology, internet bubble, and the financial crisis. So basically, what I like to do this time, what I did, I went back. If you recall, March 9th, 2009 was the bottom of this great bull market that we've had for almost 11 years. Now, what happened was on March 9th, the S&P hit 666. So what I did, I went back and I decided to read some of the headlines, some of the analysts, what they were thinking at that time, within a month or so. I want to see how was our emotional and how was our logical and again, our behavioral reactions to what was going on. Remember, we topped in 2007, the exact October 10th, the markets topped. We did have the Lehman Brothers debacle, let's say September 2008, and we've had the stimulus that started, the QEs and quantitative easing started. So but what happened? So basically, I'm going to share some of these things that I went back. I am a collector, so I have things from 1980s. I have videos from when we had, let's say, 1998, when we had the long-term capital and Russia's default, and even 1980s. Unfortunately, they're all in VHS, but I do once in a while go back and see the pundits on TV and see what their reaction was. What is CNBC, for instance, saying what's going to happen? Well, internet bubble, when it happened, they're still putting their money in. And, you know, in 1999, a lot of value money managers were being fired. It had gone so well because the value was out of style. The valuation didn't mean anything. It's the growth and momentum. And again, history teaches us lessons that when we extend that rubber band, it eventually goes back to its equilibrium. So this was just briefly, I mentioned some of the things that, you know, fellow investors, it's barely 2 months into the year, and 2009 will already go down in history as the worst start to the investment year ever in US history. So then we look at the global markets, and it says besides China, Chile, and Venezuela, all the markets are down. The stocks in 23 countries, the EAFE index, which stands for the Europe, Australia, and Far East, which is a non-American basically indexes, they're cut in half. So you can see there is a fear. This is the US markets are worse than 1929, 1930 route. Those who were hoping that for Obama bouncing global stock markets have been disappointed. And US stocks have lost $1.6 trillion in market cap since Obama's inauguration. Now, the market cap was down about 11 trillion since October 2008. And bad news is everywhere. And then I looked at the weekly survey of the American Association of Individual Investors. At that time, it was the highest bearish. So now, basically, the fear is in there. This is March 10th. This is exactly the day after the bottom was placed in the markets. And it's talking about how they're 61% after collapse of Lehman Brothers 6 months prior to that. So then I looked at another article, and it talks about year to date. This is as of February 27th. S&P was down 18%, Dow was 19.5%, and they're saying that how they share it, it's like the corporate earnings are just nothing short of horrendous. But it was interesting. I was reading something. It's like I'd never forget when the market bottom happened on March 9th. I remember David Tepper came on CNBC and said this is the bottom. And here on February 13th, this is almost a month before the markets have been going down and to find the bottom. David Rosenberg, who was an analyst at that time or economist with Bank of America, he had reduced his 2009 and 2010 the operating earning per share forecast to $46 from 56, and then for 2010 was 55. This is fascinating, and I want to show this. He projected that S&P 500 will be low at 666. I have looked at the graphs, and that was the low of what we ever had, basically, since then, obviously. And he made his prediction on 12 times multiple forwards. which was in 2010. So after that, Mr. Rosenberg decided to move to Canada. He started his Rosenberg research firm. And it's interesting what he thinks today. And he's been actually bearish for quite some time. And if you go back to Barron's, in February, for instance, he had an interview and he said, this is before all this COVID really hitting the news. He came and said, we are really overvalued, and this is going to be one of the worst recessions we will see. So if you want to follow him, it's interesting. Again, he's been bearish, so it doesn't mean that he's done all the right calls, but it's just that 666 really made the impact on me. And of course, this is a hindsight, and I see that. And then obviously the other analysts, there were two top other economists and analysts, they had forecasted that, like Goldman Sachs had said that the S&P by year end will be 940, and we were up, so he was projecting things will move up. Another one was this one. It says this is after the 2009 bottom, and that week when it happened. So the reason I'm, again, sharing all these things, I want to see, do you have the same feel today? Did we have the bottom on March 23rd? Was it the feel of a lot of fear everywhere? And after that, was there a big change in the mood and what was happening as far as the, after that week, for instance, when we had the big rebound in last 2 weeks, really, what are the feelings of the analysts? Everybody's like, all of a sudden, is this a V shape? And everybody's like on the bull market right now. So this is what happened in 2009. This has been the best week of the US stocks market since November, with the Dow and S&P 500 and NASDAQ all are up. So there's a harmony here, right? Everything is up 10%. But this is what's interesting. Remember, financials led the down leg big time. But they're leading they're having several shots of good news, promising revenue reports and positive regulatory easing. It remains to be seen whether this upswing is sustainable, but 3 data points, and this is very important. We talked about the GDP and the consumption. The sales at US retailers in February were down only 0.1% in February. Economists were expecting 0.5%, but down 0.5% actually. And if you exclude auto sales, and it was actually up 0.7%. And the January actually doubled it to 1.8%, which was the best month in 3 years. Also, the National People Congress, well, China, the premier, Wen Jiabao, says that they actually had achieved 8% of GDP growth in 2009. This is completely opposite of, as you recall a couple of days ago, when the projection was the worst since 1990, since we really have followed the GDP growth of China. That was the worst they ever had. They never had a contraction. So last piece I will read is the China Central Bank predicts that the copper and aluminum prices could rebound to 2009, which they did, by the way. I was a big buyer of, in 2018, December, I saw copper at 150, and it was just, I had mentioned it before, either the mining, they had to close their doors or something, they should have, the demand would come back, and that's what happened. And gold could hit a new price peak this year. In addition, the People's Bank of China says oil could bounce back strong in the second half of the year. In Russia, fears of large-scale default have not materialized. A number of Russian companies have succeeded in putting themselves on a sound footing by rolling over or restructuring their debt burdens. Now, granted, we started as a health. This is a health crisis, and I've mentioned before, this is a business, small business, and it's like an average investor person crisis now. So the banks are in pretty good shape in some ways as far as their capital structure goes. But on the other hand, they are you look at the earnings, this was just a peak when we saw Bank of America to Citibank to Morgan Stanley, you just name it, Wells Fargo, JP Morgan actually came out. And so basically we don't know. There's so much uncertainty, the effects. At that time when we had the bottom in 2009, we had so much pain. It took 18 months from peak to, from October to March to have a good indication. We only have had this like a month and a half. In 6 weeks, I'm not sure if we have enough indications to see what's going to happen in the future. And that's one of the reasons, again, the markets are being pumped with so much money. The last part I will read, I think it's the last one, is, so this is from the US funds. I think there's one more page. The major market indices, you know, they rallied this week again, 10%. The value was ahead 13.6% compared to growth. Then the Russell 2000, which I emphasize this again, that led us to the down, and then Russell 2000 should be the one who can take us to the top. And that was up 11.98%. And you could see the harmony all over the markets. Okay, this is the last one. The strength was the two top performing groups were banking sector and diversified banks and financial services. They were up 59%. And the Citigroup, JP Morgan, Bank of America, they were all profitable for the first 2 months of 2009. And Warren Buffett also made positive comments about banking in general, highlighting Wells Fargo and company specifically. And also conversion, again, related to accounting rule, raised some optimism. So again, remember, this was the bottom when we were down to 666. And the weaknesses, you can see the brewers and the wineries, they were, as you know, I mean, the alcohol use has been up 62 to 75% in the last few weeks. So it might be inverse again relationship. The opportunity is, although the level of merger acquisition is low compared to earlier, but there's still opportunities in 2009. And the threat in this case, which is we have the same thing in a sense, which is going to start happening, is the tight credit conditions, which is a threat. And that's what we haven't seen with our banking. I mean, just think about people who are refinancing right now. I mean, it's become so difficult to obtain even refinancing. Now, getting mortgages, it is not, a lot of banks want the 20%. They want a high score, majority of them now. They want 700 and more. I remember that's what happened in 2010, 2011 as well. When I knew so many friends and family and friends that they were like attorneys, husband and wife, 700. They could not buy a house. And I think this is what we haven't seen. We don't know what's going to happen because the banks learned, the financials, they learned their lessons and they're going completely opposite the way they were doing in 2005, 2006. Going back to the history again, this is the 2008, 2009, a chart of the QQQ, which stands for the NASDAQ 100, and that's very much technology oriented. I've mentioned again, this is this is the 2008, we call this waterfall. And waterfall is when in a short term, you have a major move. If you go back again from February to March, that's called waterfall. And in waterfall, most of the time, because it happens so rapidly, and if you recall, since 1929 when it happened, this was the fastest. In 33 days, we went from top to bottom, and depending on the index, we were down from 33 to even 40%. And usually you will have rapid bounces, and we call them oversold bounces. So they can be 20 to 30%. And because the market's just so oversold, again, I use that rubber band analogy, they just pull so hard that they need to come back to the norm, but they're still moving. So basically, you will notice that a lot of times it's a lot of weaker, really beaten up stocks are the ones who come back up. And I had mentioned, still it's my belief that we will not have a V shape, which means we go down here and then move up, which looks like right now, if you look at the market, I will explain when we get to the market analysis. It's very hardly you will have such a big drop that it will move up back like this. It's only happened in 9 times we've had this type of a waterfall. We've had it twice that we had a V shape. One was in obviously the October crash of 87 when the markets dropped 508 points or 22.3%. And then, Chairman Greenspan, and then we had the plunge protection agency, if you recall, and the government came in and injected a lot of money, and they set that up to make sure nothing like that happens again. And that's why we have the down limits and all that. But other than that, the only time we've had this was December 2018, when Chairman Powell, who had just been appointed, and he started raising interest rates. There was 2 problems. Number one, I had mentioned again many times before, the central banks around the world, we have fundamentally so many problems with our credits and liquidity in a sense of the credit worthiness, that all the central banks around the world, they need low interest rates. They cannot afford, they know that. That's why we have so many negative rates around the world. So basically, when the United States started raising the rates, it put so much fear in lower investment grade bonds and a lot of obviously non-credit worthy corporations. And that's why we had that big drop. And what happened in January? Chairman Powell, those 2 things I mentioned. One, he didn't know how to speak to public in a sense that the way the public wanted to hear, the news media wanted him to talk. And the second thing, so he learned how to respond and communicate. And the second thing, and if you recall, then he said, well, we are not gonna raise as much as we thought we would, and eventually they didn't, they started reducing rates. So the market came back. So it was a rapid drop, and then it was a rapid moving up. So those are the only 2 instances I've seen that the markets have a V-shaped recovery. Well, this time will be different? I don't know. But again, I'm going back to the history and I'm looking at the QQQ. If you want to have a healthy market, this is the big drop. We have a nice bounce. We come and kiss that, the first low. Hopefully it's not anything like this. You can see it goes up and down. If things are working, then this is real. And that's what we need to see when the whole market moves up. And I will talk to you in our market analysis, what is happening again this past week. What happened 2 weeks in a row? It's been unbelievable. And especially the technology or the NASDAQ is just moving so fast. So this is what it's called double bottom. And that's what I know last week we had a little lesson, and you can see that's what I am expecting, basically. Again, I might be wrong, and I will explain in my market analysis what could happen that I might be wrong. I went back, I looked at Berkshire Hathaway. I've encouraged you actually, obviously many people are a big fan of Warren Buffett. He hasn't, in the last 10 years really, since we had that the big bull market started, he really has underperformed. He's a value investor, but I mean, if you have even if you're in cash, I wouldn't mind, because of, again, no commissions, buy in it, as the market's even going down, you just dollar cost average, buy 1 or 2 shares at a time. You don't have to buy everything at once that you're committing yourself. Look at what happened to Berkshire Hathaway. We had this waterfall. It came back and bounced back up next few days, came down again, went up, came down again, broke the low of that, came back and broke the low of that low, and then eventually we broke the low of when we had it in October of 2008. we ended up, from March low, we ended up having this nice movement. I will discuss this Fibonacci. These are the Fibonacci numbers that I will explain a little later. All right. I also mentioned gold, and we are comparing, look what has happened to gold. And gold is obviously, for many reasons, it's the only really investment vehicle that holds this value. It's not an instrument of real investing. Not many people have made money from 5,000 years ago. If you put the money in gold, you have kept your value based on the hedge against inflation, fiat money. Your dollar from 1800s will be worth 1/10,000th of it, but the gold keeps that $1 value. If you had $1 in gold, you still have a $1 in gold. Now, they go through the cycles, granted. So I mentioned before, in 1980s, I was accumulating gold for collection reasons, silver coins, gold bars. Did nothing till 2002 when the recession happened and we had all the troubles that we had with the bubbles and everything. And then decade of 2000 was fantastic for gold. And then 2011, it topped out. But this is the reason I'm showing this. Look what happened. We had that October, the top, then the October drop. And then this is the March, this is what happened in around March. The gold, after that big drop, kept going, and then it kept going, and eventually it topped out at like $1,940 or so in 2011. About I think it was spring of 2011, and silver topped out on April 24th at $49.24. I remember that because it was my birthday. Never forget that. I bought put options on silver, and I was in a meeting, and I said, "My God, silver is at $49.24. This is time to sell." And since then, the silver has been going down. So it was a good birthday gift at that time. The last thing about history, numbers mean nothing as far as returns. So I just want to share with you, this is the annual return of the Venezuela, the index of Venezuela, which is the IBC General. The 2001, remember, all the markets around the world were getting really demolished. And that was the only time we had 2000, 2001, 2002 in the United States. We had 3 double-digit drops. Well, Venezuela has 176%, 156%. 2008 was only down 7%. 2012, 300, 2013, 480%. This year, 2019, we were up 5,520%. And why is that? I don't, obviously, the currency is just worthless. So that means nothing. But so we don't want to just play the numbers game. And the reason, again, I'm showing the history, just because something is up so much, that doesn't mean you can make any money on it. Because if you lost 96% of your money in 2017, going up, 1,000% still. Remember, from $100, you went to $4. How much money you have to make up for that $4. And then on top of that, you made that money, then you have to exchange it to dollars. So I thought this is a good lesson, again, in the history. I'm looking at the Tehran Stock Exchange in Iran. We just passed 650,000. It was 372,000 on January 1st, something like that. We're like 650,000. We are up we almost doubled in the stock market. 2 years ago, May of 2018, at that time was like 95,000. So just by having these numbers, that doesn't, again, there's a lot more than just looking at how much return I got. All right, here's my market analysis as far as what I see, what the markets are going to do, and again, where I could be wrong and what is going to happen. So a few economic facts. This is from Oxford Club, and I'm looking at the New Deal. I mentioned about GDP. How much money did we spend? The government came in and they spent about 6%. During 2009, the American Recovery and Reinvestment Act of 2009, we spent a little bit than what we did in New Deal. And here is 2020, just as of now. I'm not sure we are done. There's a lot, I think there's gonna be more to go, and I explain why. We are almost at 15%. 15%, remember, it was like 6%. And I tell you where I have problems with the percent of GDP and why I think this we are not over the hump yet. This is from Rosenberg's research. I mentioned David Rosenberg. It's just, he went back and he's looking at, oh, the market goes up. You know, I remember in like 1999, everybody was a genius. Oh my God, my portfolio, I mean, making $300,000 was nothing. Everybody was genius. And then they lost it all. It was like, oh, I'm rich. Oh, I'm poor. And then we had the real estate. And then we had this is the personal disposable income. What that means is that the percentage of how much of your net worth is percentage of your disposable income. So if you have, I don't know, if you have 10,000 disposable income, then 650% of that 600 you will have it in your investment. So basically, again, you're all feeling really good, and then of course recession happens, and now I'm poor. Everybody lost a lot of money, and these are like interesting coincidences as far as the percentage goes. And this is where we are now. People are looking at their 401ks, and I also have a little problem with using indexes as a criteria because, you know, S&P, remember, we bottomed right around here. Do you think the average investor decided to go back in within cash? They waited, and because we don't know where the bottom is. Indexes don't care. Indexes are basically the clock starts here, ends here. For every investor, we have so much fear, and it goes back to 1930. If you have grandparents who lived to great-grandparents who lived to Great Depression, you know, for how many decades, even this day, they avoided to play the stock market. This, I mentioned again, this psychological effect stays with you for a long time. The same thing with the real estate. I mean, a lot of people got burned in the 1980s and they never got back. And the same thing here, they were very shrewd people who started buying real estate. I think they bought them about March of 2011. They started buying a lot of investment properties. So that's where the risk comes from. That becomes a calculated risk. But what I'm trying to say is, believe it or not, from 2000, there was analysis by US funds to 2018, markets showed like they were up like about 4% average annual 3.7%. Average investor was up 1.6%. Just because, first of all, we have mutual funds, we have cash, we don't time the market. So basically, the numbers that you're getting based on indexes does not reflect your actual wealth. Now, some people have done better than that. Some people probably worse than that. Most people we do worse than, unless we're like really good at market timing. Even people who, like John Paulson, who knew about the, as far as the mortgage-backed securities and default swaps and all that, he made a couple of billion or 4 billion. I mean, it was like he made tons of money. After that, he's lost 70% of his return. I mean, he was a one-time, I mean, he still manages hedge funds because he's got a lot of money coming to him, but he made one right call and then he made tons of money in this drop, but that doesn't mean he's right all the time. So you will see a lot of one-time wonders, like those one-time hits. If you listen to your Amazon music collections, you will see they're like great songs, but it was like one song. Markets. You look at NASDAQ, what happened in the last 2 years? I mean, last 2 weeks, and you say, my God, are we going to go to the top of where we were in February? What's going on? You look at Amazon, you look at Netflix, Apple, Microsoft, Google is moving. What is going on? Well, this might answer one of your questions. In 2000, the market cap of 5 largest components as a share of S&P 500 were 18%. What that meant, their movement translated to the 18% of the S&P 500. Today, we're at 19%. Basically, what that means, 5 or 6 stocks, we call them FANGs, they're responsible for a big chunk of our movement. Is this real return? I don't know. I mean, is this the real markets? Is the breadth there? Is the markets are moving in tandem with what Amazon? Amazon is in its own world. I mean, Amazon, people, you know, he goes, it's up at 2408. It was at 1800. Not long ago, it was like 1900. And boom, bad news comes, it gets better. Good news comes, it gets better, because I think we have completely shifted our the behavior as far as consumption, and I think they have their own little world. So the other ones like Netflix, again, is the behavior change. People are staying at home, and so basically, but is that a true reflection of the market? Wouldn't it be better if you just bought FANG stocks and forget about the rest of the market? So this is my other hesitation about what's happening with the markets. The other thing I want to mention is what happened last Thursday. Last Thursday, you got, not this past Thursday, the one before, obviously the Fed came and said, through, I mentioned last time, through different vehicles, they're going to use the treasuries, and they're going to use PIMCO, and they're going to use BlackRock to actually buy the investment grade and low quality bond funds. Now, it is important. Number one, again, this was my concern in February, that if you have a triple B bonds, that they're in a verge of, if there was just one few defaults or the downgrades in the credit thing, it would have been a flood of redemptions, because a lot of the high quality and investment grade funds, they have to liquidate that, because now they officially become junk bond or the low quality bonds. So that's the main reason that obviously Fed came in with $2.3 trillion, and that's why you have this big bar. Obviously there was some, and this is what the money does. So they had no choice. Now, last week we had a little correction, but we are almost back where we were right before this. You know, we were going up, and so basically we are back to where we were, and LQD has been leading us up and down. So the question is this real organic movement? I mean, are these bond funds really not bad anymore? I mean, what is going on? Or just how much money are we going to throw at these? $2.3 trillion? Japan has been doing, they've been buying ETFs, exchange traded funds, for years. In Europe, they've been buying corporate bonds for years. So it's not the first time, but you tell me about Japan, where are they? I mean, organically, they're still trying to create inflation and get out of deflation. Since 1989, 1990, when they had that big collapse, they're still not on their sound ground. So this is, again, history basically teach us lesson. And I'm looking at the high yield corporate bonds. Again, this was happened. We hit the 50-day moving average. We bounced back, and we'll see. There's going to be more money coming in. The funny thing is, it's like BlackRock owns some of these ETFs, and they're the ones who are kind of getting the funds to purchase their own fund. So, you know, there's these games going on. And this is basically I looked at, that was the weekly. So this is a weekly. We hit that 50-week moving average, and we just broke above the 50-day, and this is a 200-day moving average. So this is a big, bonds are, if you want to learn something, learn about the credit and bonds. They are the leading indicator for the real economy. What's going to happen? They're much bigger than equities, but stocks are exotic and sexy, and it's nice to talk about them, but they're not they're just probably the smallest market in the world. So that's why it's important to know what the bond fund's doing. The other thing is the S&P. So this is what happened with S&P last week. So we've had this March 23rd bottom. We call this evening star. We had a sell-off, went down like an island, then we gapped up, which is a good sign from technical point of view. We were really oversold. There was this divergence here in RSI, and then we moved up, came down again, we moved up. We are hitting our head against the 50-day moving average. And 50-day moving average and then 200-day moving average, they are very important for algos, they're important for the hedge funds, institutionals, because they program that if that resistance is broken, let's say in this case, then they have confirmation to buy. If it's not, they usually heavy resistance, people take profits. So my prediction is, and if I was a betting man, I think this is it. For the next 2 or 3 days, most likely we will have our leg down. What will not confirm my prediction is, let's say again, the Fed comes and says, well, we're going to start buying ETFs, $2 trillion. Let's buy whatever it's out there. So now you're flooding more money in the markets, and then there's going to be movement. I mean, fundamentally, what I'm looking at is it just economically, we hurt so much in just 6 weeks. What has happened? There's no revenues for states. I mean, you go to Illinois, you start thinking about California, you look at New York, where the revenues are going to come? How much government is going to help? There is no tax revenues. In the meantime, government's printing money. I don't know anyone, any of my friends that they applied for that $350 billion SBA. A couple of them got rejected that I know. Some of them still waiting. And it ran out, if you recall. I mean, it crashed and they ran out. They're going to have a second one. I'm sure they will. But how organic is this? That's why I want to go back to history and show you, well, do we have the same feel that we did then? I'll go one step further. Now, you can see this was SMPX, which is based on the capital of the, it's the market capital of the components. So there's another indicator is like, if we had all the 500 companies were equally weighted, so you don't have the Amazons and Apples of the world. Basically, we have, let's say, equal weighted. Now, you can see we are pretty far from going up here. We still have come down, come up, but it's not the velocity that we had and the velocity that we had with the actual SPX, but that's what we use indexes. The other thing is, I look at every week, how many stocks are still under their 200-day moving average. In this case, this is at the daily, and what you could see is only 26% of the stocks, over their 200-day. 74% of stocks are still under their 200-day moving average. We've gone up. I mean, we've taken over 50% of what we had lost, but yet still 74% of the stocks or the breadth is under the 200 moving average. Now, this is extreme, and that's what it's saying. We were like, and this is the reason that March 23rd was important, because that's why we had this big bounce. But do you feel that all the stocks are really bouncing that much that it would continue to move up? We at least need at least 50%, because we moved up 50% of our loss. And then I looked at the 50-day moving average of stocks that they are below their 50-day moving average, and is about 39% of them still. Now, if you look at this, this is where that December 2018 happened. We had this big waterfall and the stocks went down to like almost 1% of them. And then boom, it just came back up. Is this going to be the same thing? I don't know. I don't know if you can have the stocks completely move up and then go back to like 80, 90% of them go back on top of their almost 95% go back over their 50-day moving average. Also, I had mentioned the small cap or the Russell 2000 should be the one leading. This is a crisis really for small businesses. So this is called Fibonacci, and some of you are familiar with that. He was a 12th century mathematician, and he said there is a pattern with the universe, and basically mathematically things move in order. So when things, let's say from the mathematical point of view, they are important numbers that he used the prime numbers and divided by each other, so the things move in the 0.618% of each other. And based on that, so this is a daily graph of the Russell 2000. So if you are kind of a trader that or investor that you're looking at maybe next 6 months, I would use daily. If you're looking at the long term for many years to come, then I've been using monthly, you've seen in past presentations, to see where are those important numbers. And basically the markets do respect that. So the three most important numbers are, the first one is 50%. Majority of, when there's a big sell-off or a big move up, the markets like to come back and retrace the 50% of the gains and or if there was loss, and then make a decision, should they go back to where they started, or would they just continue their journey? Now, again, this is on a daily, you could have it on a 1 minute, if you're like really the trader. So the Fibonacci works for every time period. Basically, you go from the high of the time period that you're using based on your graph to go to the lowest. This is Russell 2000. The second one, the two other ones are 61.8% and 38.2. So when we bounce back, 38.2 becomes our really first major resistance. Once we break it, easily we usually go to 50%. Right now, I mean, this is not made up. This is what has happened. You can see how much trouble we have with breaking that 38.2%. If we failed, then usually quickly we go back to 23.8. And then if that fails, usually it does go back to the bottom of where it started. Now, I will show you basically on like with S&P or NASDAQ, S&P is right around 50, I believe I have that chart. This is where S&P is. We did break the 50%. The thing is, any zone between 61.8 retracement and 50%, we call it ambush zone, that's his decision time. Most of the time it fails and it comes back down and it goes down. There are times that it starts this digestion, deciding which way do I want to go? Do I want to go up? Do I want to go down? For instance, the QQQ or the NASDAQ, which all the FANG stocks are there, they have already broken that 61.8. Just because, again, it makes sense when you have Netflix, Apple, Microsoft, Google, and Amazon representing such a big part of the NASDAQ, actually NASDAQ 100. So that's they already broken. But these are the major markets. So that's what next week I think is very important. So next week when we have our weekly meeting, I think we will have a better picture of where the markets are. One thing I have to mention, last week I mentioned that, I don't know if I said it, but like Easter week, usually the 18 out of last 19 times, the markets have gone up on the Easter week and before Good Friday. And the day after Easter, the markets usually sell off. And that was like one of the reasons I predicted we will have a sell-off on Monday. But if you recall, Mondays are not a good indication of the markets. It's not the best day to invest. So I usually, what I do is basically we call it faded. So whatever happened most of the time, unless there's a lot of volume coming in, that this happened last Monday again. We sold off and then we came back up on Tuesday, and that's what's called turnaround Tuesday. So majority of my investing is done on Tuesdays, Wednesdays, and Thursdays. Fridays are difficult. And if you look back, look at all the news usually comes after Friday, except a big news. And I mentioned again, the first thing on the first slide last week was don't fight the Fed and the governments, or the central banks and the governments. Last Thursday, Fed comes and $2.3 trillion. Thursday afternoon, right around the market, the 20 minutes before 1 o'clock, there's something called MOC, or market on close. Market on close is when there's a lot of contracts being bid and they're waiting to be filled. There were 1.5 million S&P contracts waiting to be filled. So they knew there's a news coming. And that's when President Trump came out with the news of, about the 3 phases of lockdown and how are we going to do. And as you know, the markets just completely went up. So what happened? That was Thursday afternoon. So 2 Thursdays in a row, we've had 2 government and central banks doing the job for the markets, basically. So this week is important. As I mentioned, that's why Fridays are also. Last Friday was the option expiration. There's a lot of, as far as there's a roll's going to happen tomorrow, a lot of closing. If you have the people who've had options, they have to close and open, they have to meet their obligations. So option expiration is not a good day to also trade either. So there's a lot of factors went in last week. The last thing I would say is the previous, not that last Wednesday, the ones before, Wednesday and Thursday, we had 90% up volume. That means there were 90% of volume that was coming to the market. They were on the buy side. So basically, usually for the next 10 days or so, the markets go up based on just that analysis. So because there's enough fuel, we don't know where that money comes from. We don't know if it was the Fed or whatever it was, but it's those facts. So, okay. And one thing is, I went back. Now, this is for the monthly. So I'm looking at from 2009. This index is IWC. So what we did, we looked at, I went back and we looked at, this is the IWC, is an index of microcap. These are very small companies. So it's not a small company, it's a micro, which they could be out of business, but they are very hidden, they're underfollowed, no analyst follows them. But in a chaos, that when there's a lot of market corrections and market bear times, we found out that under reported and under followed markets with a positive free cash flow, small companies, they actually outpace the general indexes. So when you have the worst markets, usually the microcaps lead. And you can see from here, just in the next, we go back to 2014, for instance, the next 4 years, let's say 5 years, they moved up about 285%. So they were like the best, they had the best return. So they do move faster, or this time, they move faster than the general market. So if you be patient, that might be, if you can do your due diligence. This is a general microcap ETF. The ones that did free cash flow and with the good balance sheets, they did much better. But this is just a food for thought. If you feel, and you can see we are at, again, we corrected, we came back, we kissed at 61.8%, we bounced back, we're at that 50%. So we'll see what happened, but they were beaten up the most because, again, these are small companies, smallest companies. So just a food for thought. So with that in mind, I'm gonna share about a trade that I did, and these are the futures trades. So the idea is not you go out and do futures, and so the idea is why I did it. This is where President well, President Trump came after, right around here, about 1 o'clock or 1:30, after the markets really closed. But the markets, you can see, started moving. So I did a small trade there. But that's when the announcement came. At 3 o'clock, the markets opened. This is the futures market, which are open almost 23 hours a day. So it's actually 23 hours and 15 minutes. They have a small break. For 22 hours and 45. Anyway, it's like close to 23 hours. So there's an old thing saying that buy the rumor and sell the news. So what I did, I used, this is a micro E-mini, so it wasn't, because I want to buy quite a few. I want to buy 4 contracts. So I bought some here, and then I bought some here. What I mean, I didn't really buy, I sold, because I wanted to short the market to make money. Because I felt the market did not, there was 2 news last Thursday. One was the Gilead, they came with this vaccine, which was not founded. It was not anything but somebody, a hedge fund came up with the news. And anyway, whatever it was, the market first, right around here, they reacted to that. And then President Trump came with this. And I just felt there was something was not right. So this is what I did. And I bought 2 contracts here, 2 contracts there. I covered at a loss a small amount here. But then, as you can see, one was covered, and then the other one I covered right at the opening. When the markets opened on Friday, I covered because I knew, well, there was a gap. As you can see, there was this gap, and then I just covered. The gap was covered, and I was out of my trade. So the idea is, again, this comes from gut feeling, but sometimes the news, you have to remember, after hours, it's not the professionals. There's a lot of retailers, they get a lot of, juice that, oh my God, this is over, let's go buy the markets, and usually they're wrong. So that's the only thing I thought, just share that with you. So starting a new thing this week. So I mentioned about the free cash flow, and I thought to share just a couple of educational terms with you. And there are 2 of them. Number 1, I think this is important with the environment that we are in. You want to make sure the companies that you want to invest in, they're going to be solid, and they're going to sustain their existence. They're going to survive. So the first thing is, what is free cash flow? The free cash flow is the cash that the company, and you can apply it to individuals or businesses, but in this case, we're talking about investments, the stock, is the company produces through its operation. And then they take it, whatever the cost of expenditure is on assets, it could be investments, anything else, and it becomes what is left over. So in this case, that's called, there's a cash flow and there's a free cash flow. Free cash flow is left over after the company pays all these expenses and capital expenditures, which is called CapEx. And now they have that money to do whatever they want to do with it. Now, this shows the probability that you don't have the depreciation in there. It's not in there. So you have, these are real money in their pockets. And that's what they cannot manipulate the cash flows. Basically, this way they can actually, the report that they give, it is what it is. The only setback basically for the free cash flow is, let's say you came and bought $1 million investment for your company. Basically, you use $1 million, but when you use the depreciation things, you can take depreciation and you get return based on the tax credit and other things. So it's not the true. So you still get credit, which doesn't reflect in the free cash flow, but it is pretty good. And as I mentioned with the chaos theory, when you looked at, as far as if you wanted to screen companies, very small companies with a positive free cash flow, very low debt margins, having a return on equity, they usually outperform when the correction is over. So again, the free cash flow is available to pay the creditors, investors, and it already taken all the expenses out. And it is important because they can use opportunities with that money, or they can pay for dividends or whatever. It is important that they have that availability. The second thing is, I've talked about last week, gave you a few ideas as far as exchange traded funds, and I just want to explain what it is. An exchange traded fund is you have mutual funds that you have a manager, he goes and buys whatever in his discretion, whatever investment he wants to, the securities. Exchange traded fund actually follows an index, and it's a theme basically. So they go and buy a basket of securities, and let's say if it's S&P 500, they go replicate that and they buy those 500 stocks based on the percentages are there. That becomes SPDRs or SPY, for instance. Now, the shares in ETF is a little different than mutual funds because they do fluctuate like stocks and can be bought and sold. And this is different because in mutual funds, you have to wait till the end of the day. So you can only buy and sell, or can sell once a day, buy as many times, obviously, if you wanted to. And the other good thing about ETF is really, when I started, I really didn't have any luxury. In the 1990s, I was doing commodities, and my background is emerging markets, currencies. You had to really basically pay lots of commissions, very low information data. Here, there are ETFs for every single thing, from commodities to bonds, from exotics to currencies to many types of stocks. So it really allows you that flexibility to have a theme that you're familiar with. If it's gold, there are many gold ETFs, GLD being the largest one. I mentioned Vietnam. Well, you can actually go buy ETF on Vietnam, which is VNM. You want to buy the whole Southeast Asia or China, there are like 50 funds you can devote to. So I thought this is important for you to know. The last but not least, we are almost time. It's at 3:30. That's talking about website of the week for the last few weeks. I've talked about Finviz, which I think we should have just a whole class, many classes, just how wonderful Finviz is. We can analyze that. Stockcharts.com, GuruFocus.com, Investors.com, One Stock One, which gives you the history. Forex Factory gives you the macro and currencies, what is happening around the world economically. And then I suggested ETF.com and ETFDB. ETF.com was really good for analyzing the ETFs, what is their holding. ETFDB allows you to screen and compare, just wonderful. And last week we talked about, having, like I mentioned, cloud and Hero, which is a gaming. ESOP is a gaming, for instance. Sensor is the Internet of the Things. There's Hack, which is for the securities. These are like themes that you might take advantage, and obviously this type of markets we're in, they've done pretty well. This week, with all the earnings that started last week, I thought this is a pretty good site, earningwhispers.com, and this allows you to basically look at what are the analysts thinking. You can go and visit their projection. What is so maybe I can share. Let me see if we have. Sean, can you see my?
Yes, I can see your Google.
Oh, great. So you can just Google. So basically, as you can see, you can look at the calendar. It gives you, there's a lot of different tools, but you can search your own stock, but it goes beyond that. It gives you the growth projection, how they have done as far as what is the estimates, revisions, which are very important. The revenues, actually, revenues, but if there's been any revisions. And I thought this would be interesting with the with you're gonna have for the next few weeks, you're gonna have a lot of earnings coming, and then it has a heat map. The top down looks at the sentiments, and basically, I thought this will be a timely, as far as what is the sentiment of the markets, the sectors, and anyway, just a food for thought. I know running almost a couple of more minutes, so with that in mind, I think I will stop at that and open for the questions. As I mentioned, again, this is the time to be cautious, but again, you have to define what is your purpose. Are you going to be a long-term investor? Then you cannot be a market timer in that sense. There's still lots of bargains out there, so do your own due diligence and start gradually buying. But this is an environment for still volatility is still there, and there's a lot of opportunities during the day. One last thing I will mention, why still I'm hesitant as far as economically, and I think there's going to be a lot more bargains coming up in the future, is American Airlines is like $5.1 billion market cap. Now the government is paying $25 billion for airlines. I mean, it's almost saying that come and buy me, and that's what I'm hesitant. I mean, this government, they're asking for all the money to basically they can be sold. So there is no really common sense, no logic of what's going on, but I can understand why the government and why the Fed, monetary and fiscally, they have to do this because they have to throw what they got to avoid what could have been. So they've been very proactive, but I'm still hesitant in being positive about the markets at this time. So, all right, with that in mind, I open the floor. If you have any questions, let me look. Now I can open. I couldn't see you before, so. All right. Any questions?
Hello.
All right, I'm ready.
So, Ramin, if you can hear me, I'd like to pose one question.
Sure.
When you show the historical or market chart for the longer horizon,
yes.
I did say in the 1970s and early 1980s, that's a long time, almost 7-8 years of the market downturn. Do you think we can get into that long horizon downturn? If as a long-term investor, we want to get into the market, but definitely don't want to go through the long term for like 8-10 years.
Correct. That's a valid question, because if you recall, there was something called the lost decade, let's say in 2000. So if you had invested in 2000 and you want to retire in 2010, for instance, you basically earned nothing. Or let's say, like exactly you mentioned, like we had the bear market in the 1982-83. Finally, things came back from 1966 to 1982. You would have made 0%, and those are. Although the rolling, if you looked at the 5-year, you would have made money in that sense. If you every 5 years you put your money in, and that the problem is, you're absolutely right, and that's what the diversification comes into the picture. Why? Because each instrument has its own cycle. For instance, I mentioned, the 1980s and 1990s were fantastic for equities. Now you look back to oil and commodities, it was horrendous. So gold did nothing, and a lot of other commodities it was. But then you look at the 2000s, the commodities came back. Real estate goes into, historically, especially from UK, they go to 18-year cycles, and then you have a short-term 8-year cycle, and then 12, but 18 years is a major cycle sometimes with the real estate. So with equities, remember 2009 to 2019, we were in a big bull market. So 2020 and on, my feeling is you look back to international equities and international investments, they have underperformed our domestic by far. So my thing is I'm shopping, I'm looking around demographically, I'm looking at some of these gems out there that I think they're pretty much undervalued, and you can use whatever criteria you want to use. You can use the Schilling, cap E, and you can find a lot of from the PE ratios. There's a lot of bargains out there, and just be patient. So what you want to do is, I think what happened from 2009 to 2019, I think fundamentally we did not solve our problems from the 2008 debacle. So we really, basically we just put a nice lipstick on and just made it look good, but I think that's the problem is. So yes, I don't think you're gonna see that average return of 10, 12% a year in the markets for the 2020s, at least not in the United States. So this is a good time to become an analyst. And I think the passive investing has been, I know, God bless John Bogle, which I've been with him, I've talked to him, wonderful man, and he passed away last year. He's believed in passive, and it makes sense, but I think you're gonna see more of an active investing, and that's one of the reasons, again, we have this classes. I'm hoping to give you enough tools to have that understanding to see that basically you're capable of maybe doing your own research, filter things, filter the news. CNBCs of the world and Fox and Bloomberg, there are commercial entities. They have to make money, so it's more of an entertainment. So you can put it on mute and just watch the ticker if you like. But you want to have fundamental analysis, fundamental understanding of why you bought a stock. Why is that? Or if you're going to be a trader, then you want to be more technically oriented. So it's a long answer for your short question, but I agree. I mean, that's what I think diversification. If you get in the market, I would not put in the, a very, I won't go into S&P 500 and I put it all in one thing. That's why you have these targeted funds too, and they've been attractive, but it all depends of the fund manager. So, I don't know, did that answer your question, Sean?
Yes, thank you very much.
You're welcome. All right, any other questions?
Yeah, I had one, Uncle.
Yes, Kenneth.
I remember you mentioned that alcohol right now is up 60%, which I'm guessing is due to the quarantine.
Yes.
So, you think it would be a good idea for when the virus is blowing over to short alcohol?
Good. Actually, that's one indicator. I give you a good example. That's a good question. Look what happened on Friday. The markets are up 600-700 points. Mm-hmm. Initially, the Zoom that we are on, it dropped. Amazon dropped, and some of these we call them work from home stocks. They were down, and that's what happened. But then it came back up. So basically, some of these, I think, technologies are going to be with us. As I mentioned, that the Amazon and the behavior will be there. But some of the teams are going to have their ride for a while, but then they're going to kind of level off. I mean, Zoom probably going to have a very good, or Amazon is going to have a great reporting. So, but then you have to remember, markets they look at, it's a discounting vehicle. So they look at 6 months from now. So if that's the case, they will look at, let's say, but for beverages, for vodka, there's a STZ, it's a symbol. So you can, if you notice, there's one like the alcohol and what they call it, the stores, they are the only ones who are open. That's because other places are closed, so people have been using it. But it's a very small. You look at that. You have to also remember it's not alcohol use up, but it's a personal consumption. with no sports events, a lot of activities, no gathering together, you don't have parties. So that part is really have eliminated from the business part of that concern. So once things get back to normal, that's going to be replaced. So I would not just go short it. I just mentioned the consumption. I didn't say the stocks are up 62%. I meant consumption is up personally. But again, you know, you're not at a ballpark, which that's where you go to. You don't go watch the game. You go to have hot dog and beer. So basically that's been done. So yeah, I mean, it's a good observation, and that's what I want you to do. Sit down and come up with some themes. What's going to happen a year from now? What is people's behavior? Anyway, okay, good question, Kenneth.
Thank you.
Of course. Any other question? Hello?
I mean, Hamad here.
Oh,
can
hi,
I ask one
Hamad.
question?
Of course.
I wanted to ask you that normally when you're going into a trade, what is your exit strategy, especially if you're going in something short-term versus long-term? Does it change based on that criteria?
Excellent question. So actually, I had so many materials. So that was one of my things I want to do, but it would have taken a little time, and I know your time is valuable. So if you don't mind, I'll briefly mention it, but I would like to do a session just on that. I have 7 rules I use, and the rules are, they are like fundamental. I just give you a brief one. So you have fundamental reasons, you have technical, you have sentiment. So, and basically then you have money management, right? So I look at fundamental quickly. What that means is if you got in because of the earnings, the balance sheet is good and nothing has changed, if fundamentally nothing has changed, you stay in it because you believe it's the market is like doing its buy and sell or whatever. But you know, and that's why the value investing could be a good time. And that's why, like, I'm sure Warren Buffett is looking around to find values. The second thing is the technical, and that's why we use, let's say, moving averages, and we look at, let's say, support and resistance. You look at Fibonacci, you look at indicators like RSI, stochastics. So that will give you buy and sell. The third thing is, I mentioned from the sentiment, you will see there's a lot of, like we looked at, there's extreme optimism and for no reason, then you know something is not right. The fourth thing will be your own price targeting. I usually, like for my investments, the stocks, usually when they base, it's their buy point, historically they go up 20-25% when they have a good base. They rest again, they go up to, so I have like a 20-25% target in my investments, minimum. My options, I go 25, 50, 100, and a runner. So basically you have your own financial or a price targets in your mind that you will be happy. Opposite of that is, what is the sell rules? It's complete opposite, but let's say if you have a 20% target, you don't want to have a 20% loss target. You usually, like Investor Business Daily or Bill O'Neill says 7 to 8%. It's up to you. Basically you say, I can sleep, I can risk 2% of my whole portfolio. If you have a 10,000, I can lose $200. I'm okay with that. If you have 100,000, I can lose 2,000. If I got into stock, if it's $1,000, okay, if I lost $80 or $90, then I put the stop loss. Usually, if you have done your due diligence and basically you have done, you buy in, usually if the markets fail, they drop a lot more than 8%. So they go more. So that's why it's good to have, again, the financial side. 2 cautions. Number 1, never ever have regret if you sold something, because you don't go look back and you say, oh my God, you know, because a lot of people say market's just waiting for me to buy it, as if they are like watching you. As soon as I bought it, it went down. Oh my God, you know, they want to take money away from me. And so basically what you want to do is you don't want to fall into that trap. You want to make sure that once it's done, you go to the next one. There's tons of opportunities. Use it as a tuition you pay to the market. I used to think It's a loan I gave to the market. I'm going to get it back with interest. I lost 100. Next time, I'm going to make 150 on you market. So that's how my attitude is. The second thing is, it goes back to your, again, what is your purpose? If you were the trader and you looked at the short term and you said, okay, I'm going to be in it for a week or 10 days or a month or whatever the reason is, as soon as you got in and the market is going the other way or staying, do not become an investor, for instance. So if you got your purpose correct, then at that time, stick with it. If it was a trading, you got into a stock and you said, I would be happy to make 25%. Don't get greedy. I mean, make at least half of it and do that stages. So, but that's it. But I think it would be a good, one thing, Sean, I think I mentioned to you and I announced it. I really like to maybe do like a 5-minute segments on each subject and maybe on the YouTube or something. The rules of selling, my 7 rules, for instance, or maybe do like on Fibonacci, on candlesticks, on moving averages. What is oscillators, like stochastics? How do I use these things? And my biggest thing is how to use Finviz, because Finviz is unlimited. You could have 30 classes on Finviz, but I think you have so much valuable information, just so many resources on Finviz. So that's our next project. If there's anyone interested, that's what I like to do, set up things, studies on that. But I hope this was helpful, Hamad. I don't know if that answered your question.
It did. It gave me more than the answers. Thank you so much.
Of course.
Very helpful.
You're, all right. Okay. Any other questions? I'm glad you're still with us. So that's good. All right.
Ramin, I was kind of smiling when you were talking about not feeling bad when you sell something.
Okay.
I had 2 trades that I lost a little bit of money on.
Mm-hmm.
They both went up to above where I bought them originally.
Right. No, it happens quite often, Henry. And as I mentioned, honestly, everyone, if 90% of people you talk to, they say, the market was just waiting for me to get in, to go down. As soon as I get out, it comes back up. They just know it's me. But no, it doesn't happen that way. And it's pretty much, just stick to your discipline. I have mentioned many, I mean, the biggest thing I would leave it with you, I've said it, please have a journal. Please write that the time that you don't have any emotional attachment in the market, sit down and say, this is the reasons I got in, these are the reasons I'm gonna get out. You have no play in the game. At that time, you're very unbiased. So as soon as you start changing your story and start excusing yourself, oh, tomorrow Fed is gonna do this, oh, goody, it starts hoping and wishing, then you have lost it. That's why, again, you want to be either short-term, long-term, just make sure you're clear on that. So, and that's why, again, these are great times to get in, just a little, put small amounts, learn about it. And like, as I said, there's no commissions. So, and the taxes, although I think with all the revenues, this is one thing I forgot to mention is, what the states are going to do. I mean, if you think you have tax problems, I think it's going to get a lot worse because the revenues need to be gotten from somewhere. There's no free money in life, believe me. So anyway, all right, good question, Henry. I mean, good observations.
Well, I just tell myself, maybe it will help other people, is that, I made some money.
Hello, sir. Hello, sir.
I made some money on some other trades, and overall I didn't lose money. So that's my main goal, is to not lose money and then of course I want to make money.
Yeah, exactly. I mean, majority of people lose when they start. Sometimes they get the beginner's luck, which is the worst thing. If you ever had the beginner's luck, that's the worst lesson you will have. The best thing is the failing and learning, but small failing. And as I said, it's the tuition or the loan. Just look at it that way, Henry. Again, this is a loan you gave them, and you're going to get it back because you're learning. And it's almost like soccer. you know, once you learn the objectives of scoring goals and not letting them to score, getting the basics right, and eventually you don't even have to think. I mean, when I did that trade on Thursday afternoon, it was more of a gut based on the history. Just have seen it enough, and the more you're involved, you see the patterns repeat themselves just because human psychology repeats itself. So yeah, I mean, we talked about UGA, for instance, United Gas, right? I mean, the gas prices are really low, but yet, I mean, if you bought it like 9.5, I mean, it hit like over 13.5, while the oil is down and all that. Why is that? I mean, just these are the patterns. But then you don't want to be greedy, and you say, okay, I bought 100 shares of it, and UG at 9.5. Let me take half off at 13. What's wrong with that? I made, 35, 40%. That's a pretty good in 2 or 3 months, I mean, 2 weeks. So something like that. But anyway, okay, thanks, Henry.
Thank you.
Any other question? It's
Ramin, this is Chris. Can you hear me?
Yes, Chris, of course.
Came back to my other computer, and Ida and I bought a little bit of spread on Apple, and I wanted to look at your earnings whispers because they report April 30th and understand what the earnings whispers are telling us. What is the most important thing to look at? Could you help us go through that and see what you would consider most important to look at?
Okay. No, after saying all that about earning whispers, I am right now, believe it or not, there's just so many things at limbo. So I just want to give you that so you can look at it. But unfortunately, there's just so many variables about the future that a lot of companies are coming and they're not giving the real projection for the past looks good, but the future, for instance, let's talk about Apple, right? So they got downgraded, and why is that? I mean, obviously with the iPhone usage and then their factories and all that. So is that going to affect their revenues? Most likely. You go to their stores, they're not, they only open. So this is of all the times probably the worst time to look at the projections. So you really have to be very price oriented at this time. So, but I will go to, let me see, the earning whisper, and let's look at Apple. So you can see that the analysts, majority of them, obviously they have a buy alert. And so basically here, what they call pivots, basically they give you the probabilities and their support. So at the price of 282, they're looking at the resistance, and based on, so what they do, these pivots are based on technical analysis, but also they look at the options and the premiums that were put on there, and they use that. And you can see there's a $5 increments, but based on the pricing that they have looked at, they show the variability, which another day I'll show you how, if you have Thinkorswim, or if you have Tastyworks, or if you have TradeStation, that the options allow you to show what is next week, for instance, the movement in that stock. So apparently in this one is a $5 increments movement. So this allows you to know, okay, if the market is pricing in $5 movement, these are the things that I should look for. If I'm shorting it, well, these are going to be the place that it could go. So as you can see, they had Friday was not a good day for Apple because, again, they got downgraded, but it could be short-lived. But these are the trends. So they go based on the more of a charting, but you can see their earning estimates, something happened there. So you can either read about it or at least know that what is, as far as what was the reason and who downgraded it, and we would look at that. one thing I like, it's like, I like to see that, like when the worst times, when analyst sentiments are really low and earning estimates go up. So when everybody's selling, and then you have to remember that the majority of the analysts, they have herd mentality. So they go to the same parties, they go to the same bar, restaurants, and then if you notice, one says, what did you do with that stock? And I got a buy rating, and the other one says, oh, good. So nobody wants to be the oddball. Very few are oddball. So you have this cumulative, as far as consensus. So, but this is your answer right here. So you can see the expectations.
Sean.
Annual earnings up about 2.3, but the rest of it, basically, you can see there's been negative revisions. So it's going to be very difficult quarter or next quarter as far as understanding what's going to happen. So, but I look at these earnings more of into smaller companies that a lot easier to understand. So then they have other tools that I thought they are, from bottom up, you can see the earning revisions are important. The top down, I look at the sentiments, the heat map, and then calendar. It's just a main thing I want to see. If you look at, you want to look for opportunities, see if there's like, obviously a lot of healthcare companies are probably going to have some promising earnings. Maybe, Abbott did. And so those are this allows you to do. So, but it's like just play. I don't do a lot with earnings myself, Chris, because I am, again, I do look at, I'm a macro, but also look at the things from demographic or by countries, but then I'm also a trader. So I follow the technical side of things. I look at what is the sentiment of the markets, the patterns. So although I was an analyst, I was a financial analyst, all that, if I do have a long-term horizon, I look for more of a value investment, then I do a lot of research. I know Apple, everyone has done all the analysis on Apple, so I don't really bother with that. I might play options on it, but not just play that. I don't know if that answered your question, but
yeah, it did.
Yeah,
it did.
Okay, good.
Thank you very much.
You're welcome. Of course. All right, it's 3:53. I really appreciate everyone staying. So, any other questions? Anything that I didn't answer? Again, there's a lot to cover, but
hi, Ramin.
Yes. Hi.
Yeah, very interesting webinar, sir. Yeah, really enjoyed that.
Thank you so much. Thank you, David. Appreciate it.
Yeah, I just the question I have in mind, because of my own experience, I did a lot of good and bad experience on Forex. I was wondering, is there any correlation between this information we could get from this sort of website and make some conclusions on currencies between, let's say, US dollar or British pounds or this euros or this kind of things?
Absolutely. No, that's absolute. I mean, Forex, as you know, Forex is the largest market out there. It's the dollar, it's the currencies which actually dictate the world economies. It's because at the end of the day, the currency of the world that's where the trades are done. That's where the big institutions and commercial banks and the companies they use. So I think it's the most important thing. And in the last few times I've mentioned that the first thing I do in the morning, I want to see what is happening with the currencies. I want to see, is the risk on or risk off? So for instance, I see if the Aussie dollar is up nicely, then I know the markets are gonna take some risk. The money is going to where the return is probably a little higher. And when we see like New Zealand dollar, which is between Aussie and New Zealand, that's the risk is. Then when I see yen is down, then I know, or yen is up, then I know the risk is on, and people are hesitant. They don't want to put their money. And I watch Aussie yen, for instance, quite a bit. But everything goes back to dollar. Dollar is the currency of stability. And whatever we do, we look at, so next week, maybe I'll just do my workstation. What do I do? First thing in the morning, what factors do I look? And US dollar is one of the most important ones. I want to see what is happening with US dollar. I mentioned last week, like the British pound, when we hit 114 and change, I had never seen it since 1985. I mean, obviously I just got in and I just bought British pound, which instantly, I mean, everyone can do that. They can play the ETF we just talked about, which is this is where I bought. So FXB is the British pound. So you can, with ETFs, you can actually do currencies. But Forex is very important. And Forex follows very good technical patterns. Especially Fibonacci is excellent with Forex. If you use 240 minutes, is an excellent time rule for Forexes. And if you do intercurrencies, they're wonderful. The problem is, not many people, at least in the United States, because the dollar is the king, not many people really want to get involved with Forex. In Europe and Asia, obviously, it's different because since you're 8 years old, you know what is the exchange rate. So everybody knows, but here they don't. But yeah, it is. And you can apply, again, I mentioned Fibonacci, the moving averages, the trending. They all work from 1 minute to daily and monthly. So was that helpful, David? Was that?
Yeah, definitely. Yeah, every second, yeah, worth considering. Yeah, I'm definitely going to rewatch this video from the from to end. Yeah.
Thank you. All right, good. Any other questions? I know it's almost 4 o'clock, so if.
Ramin, I have one more question.
Sure.
You showed the top 5 companies share of the I think it's a NASDAQ.
Oh, S&P 500.
Yeah, going back to like the historical high around 2000.
Correct.
Can you review a little bit what happened around 2000? At that time, did the leading top 5 companies actually got down a lot? And
yeah.
As of today, do you see that could happen again?
No, that's it's the idea of it, right? So it's not, basically I don't look that they go drop a lot. What it tells me that it's not the true reflection of what the market is doing. It's almost having, you're in the neighborhood and you have 100 houses and they're like 4 beautiful houses and they've gone up 100%. The 96 or 95 other houses, you don't say, oh my God, you know what? Our house is up 10% and they're up. That's not an indication of your neighborhood. And basically, if again, let's say we live in Ladera Ranch, for instance, Ladera, oh my God, the markets are up average. So when you average it out, because you have those $5 million houses and your house is $1 million, well, average looks good. But does that mean those 95 other houses are up that much? So is this a great neighborhood to go? Oh, I'm living in a place that its average price is $2 million, yet I own $1 million house. So it's the false sense of movement that I'm emphasizing. So yes, the market dropped tremendously at that time. If you recall, you know, it was the internet bubble. They were down 70%. There's a lot of companies that they went from $3 to $300 and came back down to $2. I mean, it happened so quickly. I had, it's funny, I just shared a story in the mid-2000s, I had someone from Cox Cable who was connecting my cable. And he came and he said, Ramin, God, what company it was? I will remember. So he said, Ramin, my wealth, I went from 4,000 or 5,000 to $3 million and I lost it all. And here I'm doing cables. So there were many people like that, you know, they made millions and they lost it all just because, again, that human psychology. So to answer your question now, you have to take things individually. I mean, do you feel Amazon will be $1,000 stock ever again. I don't know. I mean, you're obviously you're an analyst, Sean. So you sit down and you look at the patterns. Is Apple, is Microsoft? What is the potential with all the things with technology? What's going on? Netflix. Do you think with Netflix? Incidentally, I don't own it, but my son is part of his portfolio, and the thoughts are, after watching all these series, paying $9 or $10 a month, people say, and that was a question actually came up, are we gonna go back and say, you know what, I'm gonna cancel that $10 a month series, paying Netflix. I'm gonna go to the movie theater and pay $15 or $20 to watch a movie for an hour. I don't know. I'm just saying the behaviors might have already structurally changed. So you have to do it individually. My whole point out of that 18 or 19% was it didn't really bode well for the markets when you had such a big concentration in those large stocks, and eventually the indexes had to fall. So although, I mean, they did all the stocks actually at that time, they did fall, from Cisco's of the world to AOL's and Intel and Microsoft. I mean, all of those. Microsoft became, from growth investments, it became mature company, and they had to really revise themselves. So, but I don't know if that was clear, Sean. Does that answer the question?
Yes.
Okay, great. All right.
Okay.
So that's 4 o'clock. I really appreciate. Thank you so much for staying with me and with us, and I hope it's helpful. I hope to see everyone next week.
Thank you very much.
Yeah, thank you very much.
You're welcome.
Thanks.
You're welcome. Have a great week ahead. It's going to be an interesting one. So.
Thank you, Rami.
Okay, definitely.
Okay. Bye-bye.
Thank you.
Thanks,
bye.
Rami.
Bye.
Stay
Thank
healthy.
you. Oh, yes, please. Stay well and healthy. Appreciate that. Wonderful. Bye-bye.
Bye-bye.
Bye. Goodbye.
Bye.
Bye-bye.